Welcome to the Pure Property Podcast. Whether you are considering buying your first investment property or reaching property mogul status, we dissect the fundamentals through to large-scale property development and everything in between.
G'day, how you going? It's Phil Tarrant, co-host of the Pure Property Podcast with Pure Properties. Paul Glossop. Paul, how you going? You good?
Very well, mate. I'm very well. I was actually with
It's
that
a heavy
intro-
guitar riff. Every time I hear it, it just I
not
find it
stopping.
intriguing.
I feel
There
like
it
we're on
goes.
a Seinfeld
It's gone. But I just instantly smirk.
I was actually in my mind then. I was thinking, what time did you feel, and if you have reached property mogul status? Don't give me a cop-out answer.
Oh,
when
God.
did you think I'm actually a property mogul?
What made you even think about that?
Well, it was in the intro, whether you're starting out or reaching property mogul status. And I think that intro was set up for you because you were the genesis of the mogul.
I was the avatar
Yeah.
of. God, I don't even know how to even think about answering that question.
There would have been a moment.
We
when
met.
you-
We spoke to a property mogul on the weekend.
Oh, really?
Yeah, we did.
What defines? Oh,
He's an electrician.
That's true.
Yeah,
There you go.
he's
Yeah.
a property mogul.
He is a property
And you know
mogul.
who I'm talking
I
about.
do
And
indeed.
if he's tuning into this, which I know he does tune into this.
He was eating some slow roasted meats at the same time, I believe. Yeah.
Yeah, over a barbecue, and,
Yep.
and that's what we do as Aussies around a barbecue. We talk
Yep.
about property, and this particular property investor, who I think's been investing in property longer than we've been investing
Absolutely.
in property. And he
Far-reaching parts of the country.
He
as
does,
well.
and he religiously tunes into this podcast
Yep.
because I think Sparkies, tradies, the backbone of this great nation, they spend a lot of time on building sites, either listening to 2Day FM and they know every song on the radio, or they get in a zone when they're wiring up stuff and they put their headphones in and they tune in the podcast. You would be surprised how many people tune into this podcast and other property podcasts who are tradies. They love it.
I reckon that's probably one of the better things. If I was a tradie, that the invent of a podcast, more information podcasts in general over the last decade have probably changed the mindset of so many people who used to spend 8 hours a day listening to whether it's talkback radio, commercial radio, and all of a sudden now have the ability to say they're doing MBAs every 3 months. And they might choose the next MBA. Like there would be so many more people who I think have become so mumuch more educated by the invent of a podcast. Definitely not most of the podcasts that you're involved in, but some podcasts out there are very, very educational.
That's a hot tip, right? Like, use your time effectively and allows you to. We're talking about tradies, right? It's an easy cohort of people to have a discussion about. They typically drive to a job site somewhere, or they're on the train.
Yep.
So they've got time.
Yep.
Normally an hour commute for most of them. I'm generalising there, and then they're on a job site. Other than their toolbox talks in the morning and smoko and stuff when they engage and interact with other people. It's quite a it's quite an individualised role. Like you can, to your point, you can actually do an MBA pretty much every 3 to 6 months just by tuning into information.
Yeah, and I think it's awesome, and I think there's probably from a property standpoint, there's no I have no doubt there is far more educated and therefore ideally better invested tradespeople, and also just people who generally are by themselves and able to tune into something whilst they're doing their job because of this, which is awesome.
Well,
I actually get first-hand feedback on it all the time, which is I think is amazing.
Well, the person we're talking about, and if you're tuning into this, g'day, like he always complains that we don't release enough podcasts. So he would want more if he could. He wants more. It's you've got to be careful of tradies. I like tradies, but you've got to be careful about tradies. They're bloody smart people.
Yeah.
Like, you got this sort of, this idea, tradies, fluoro blokes down the pub drinking 8 schooners after work. Like, that's not,
Mate,
they've always been highly informed, right? Because they're either talkback radio, they're listening stuff all days, and now they're sort of dialing in.
And they talk a lot between each other. And, mate, it's funny you say that because I had a meeting with a client yesterday, new client who we've started a search for today, literally about half an hour, caught up with them, finalised the criteria, and we're getting started. One of the first things he said, because I always try to find and understand where people are starting from, what they do, where their finances sit before we can set a strategy. One of the first things he said is, mate, look, I'm a crane operator. I'm not the sharpest tool in the shed. He had his own home virtually paid off. He had an investment property. He was 29 years old. He'd had 2 children. He's married. Yeah, from what a lot of people would aspire to have a situation in their early, mid, late 40s, 50s, he's achieved that. And I cut him down real quick, as I said, mate, and I said exactly as I said, you've achieved far more. And I speak to thousands of property investors on an annual basis. I said, you've achieved probably far more than 95% of them. So either A, you're intentionally selling yourself short, or B, don't sell yourself short.
Well, what I've found, I think about this a little bit, and I get the privilege to knock around a lot of very different types of people from all walks of life. You'd be the same. You see it. And you have the ability to sort of, maneuver through different, I guess, social circles. And you see a lot of time, and you speak about that particular tradie who has this level of consciousness, and that's the humbleness of a lot of people. They just go, look, what do you say? I'm not the sharpest tool in the shed. Probably bright as a sharp. Yeah. But then you hang around a lot of really, really smart people, right? Like doctors and scientists and stuff, like really, really smart. And I'm not the smartest bloke, but I'm smart enough to know what I don't know, and I'm smart enough to be vulnerable enough to say, I don't know, can you help me?
Yeah.
Right?
And that's the awareness.
That's the skill. Yeah. So the relativity of your intelligence doesn't matter if you don't have the ability and skill to ask and to listen.
Yeah. And most people have 2 choices in those situations, right? They can say, I don't know, I'm going to spend time to figure out it or learn it. And a lot of the time, some of these things take an awful long time to actually learn them properly. And in some cases, it's the whole 10,000 hours of mastery. And that could take a generation. That could take an eternity. The alternative is exactly like you said, I don't know, but I know someone who does know, and I trust that person. And I know that is, by paying whatever they're charging, that fee is going to be the expedited way to get me there far quicker than what it would be. And to your point, that I do speak to a lot of the other side of that ledger who are the very well educated. These are the masters, the honours degrees, the MBAs, and working in very, very niche markets of whatever they do for a living. And I'm not going to generalise too much, but I'd say more often than not, they are the procrastinators, because they want to wait until they are completely comfortable knowing everything that they need to know, as opposed to saying, I know about 80% of what I need to know. The 20% is the hard stuff, which just takes too long, so I'm outsourcing that.
Yeah, see, I sometimes sit there thinking, going, and I say it with my wife and stuff, just go, we're just fortunate that we're not too smart. You know what I mean? Like we just go, like, it's nice to be just like, oh, I don't know. Like it's just,
I know someone who does know.
Yeah.
And I'll, if we really want to do that, I'll make a phone call. Yeah. And it's funny, but the next guest for our next podcast that I'm going to be bringing in is actually a person that I have in my team, and he's already locked in for this next podcast. He's actually a private development partner of mine. He's a town planner. He studied law. Super sharp guy, but very unassuming. I lean on him for everything when we do developments. I source sites and I organise finance and I do FISOs. This guy is the guy on the technical side of things, which I just don't have the ability or the time to invest to get to where he has. And he has allowed me, from a personal development side of things, to just catapult into things that I would never have done without the confidence and the knowledge of what he is. And vice versa, he leans on me for other things. And that's a great example.
Well, that's the ideal partnership, right?
Absolutely.
There's got to be... And most, a lot of people talk about investing in syndicates and stuff and go, if it, like 90+% of all Australians probably invest in a syndicate.
Yeah.
And it's normally with your partner.
Correct.
So you're investing with someone. So, partnerships are critical when it comes to these type of things. And you need to be bound by common values, but you want to have skill sets which are at other sides of the ledger.
Yeah.
That's how you can really advance.
Absolutely.
That's how you want to try and shape stuff. And what I see with in property investment, what works well is, probably at a smaller level to what you're talking about is people identify where their skill sets lie, and they will take on or be responsible for aspects of the property investment journey. And that might be, one person, looks after the home life and someone is the primary investor, and they've got a good collaborative discussion around working with each other. They might help each other here and there. Like, people find their own pathway around this. But, it's okay to be clear about, okay, I'm going to do this, you're going to do this. These are our individual responsibilities, these are our shared responsibilities, and let's create a mechanism for how we can sort of connect and collaborate so everyone's informed and no one's doing anything in isolation or a bubble. Because I imagine that would be a problem that you see a lot, is where you get polarized relationships where someone's like gung-ho and really invested and does things by themselves without bringing on the other, probably equity partners, what it is, along for the ride, and that can come unstuck.
Mate, that's probably the best point I've ever heard you bring up, Phil. And I'll tell you what, you haven't brought up many good points. So it's a very low bar. You're jumping over there. But if I'm being honest for a second, like, I mean, that is, for me, it's probably one of the most obvious fail points in an investing syndicate, i.e., people investing as a couple, is that it's the point where the people who fail more often than not are the people who rely on one person to get on board and one person who doesn't give probably the free rein to say, look, I trust you in this. I need you to give me the insights that I need to be comfortable. But once I'm comfortable, I'll leave it to you to drive it, because trying to get two people on exactly the same page and two people fully informed and two people fully comfortable, if they want to know exactly the same level of information, it's a nigh on impossible feat to achieve. And most of the time, the people who are trying to get there are the people who either don't do it, because they just sit on the sidelines, or if they do it, they exit too quickly because at some stage, usually sooner rather than later, one of the two people in that syndication or that couple look at it and say, I didn't want to do this in the first place. I got that third email about this repair now that has to happen. We've got this property vacant. It's been 6 months. We haven't even seen the property grow. I hate this. I'm out. And I've seen that happen a lot. And not because the property is a problem or the property manager is a problem or the finances are a problem. It's typically because one person just wasn't on board and ultimately they leave it. And that's where the fail is. They just either don't get on board when they should because they procrastinate, or they exit way too soon because they weren't on board or in a partnership in the first place.
It's a core point, and we're talking about there in some ways is this intersection between perception and perspective. We like peas on this podcast, so I'll continue that. So that's someone's perspective on the situation, and that's shaping an emotional response to it, which is detrimental probably to many different factors, probably the relationship and their happiness and their financial future and all that sort of stuff. It's very hard for people if they don't have the information they need for them to have an informed view, or it's light on because they don't have the capacity or the capabilities to see it differently. Is we have issue. It's hard to go out from having that very sort of tunnel vision view of your perception on something to actually stepping back and gaining perspective. And we talk about working with people in and around property investment, right? This is, people go, I use a buyer's agent to help me find a property. I use an accountant or your professionals. Really, their main role is to give you that perspective.
Correct.
That's so they can help you look at things differently or change and shape or maneuver your thinking around something because they're looking at detached and from a less emotive point of view, understanding, appreciating your personal circumstances. So it's hard to quantify that, you know, like I surround myself with a team. I do it myself all the time. And that's pretty much I'll pick up the phone. I'm conscious enough to go, I think this, I have a perspective on it, but I'm probably not right on this. So I'll call you. I'll go, hey, what do you reckon about this? And you'll give me a version of it. Yep. Or I'll call someone else, they'll give me a version. And then I'll use that information, situational awareness, if you want to call it, which will help me shape a decision. That is in many ways what your team, a good team, will do. And often the clock isn't on when you're doing that. If you've got good relationships with trusted advisors who you pay money to over the course of the year in many different ways, but it should get to a point where you can just call up and go, whatever. And if someone goes, well, I'm not going to give you that advice because I'm going to have to charge you for it, you're probably working for the wrong people, right? But you've got to expect to pay good dough for it, you know, at an aggregate level. So anyway, it's a really important point. So to close the loop on that, property mogul, we know who we're talking about. I'd say he's a property mogul.
I would say so.
Because he has great perspective because he's highly informed, he's highly educated, he's highly invested in the outcome. Personally, I reckon he could do more. He's probably a little bit of a procrastinator. I reckon he's very conservative, and you know that's a compliment as much as anything. I'm not having a crack at this guy. He's goal orientated. He really knows what he wants to do, and he's got a vision. He appreciates his partner,
and they are uniformed in that.
He has an acceptance that he's going to need to work for quite some time, even though he doesn't particularly like it. But he's really able to connect, and I don't know anything about his personal finances, but I think he has a direct correlation between I've got to go and do some weekend work. I think he would mentally, and I've never asked him about this, but I'm just assuming this, he would mentally say, if I do that, that's going to result in this, and it's actually going to directly corroborate or connect to the goal that I'm trying to achieve.
Yeah.
And I imagine that's how he's wired.
Yeah, it's not a.
Does he work with you, this guy?
Yep.
Okay.
Yeah.
I'm generalising here, but that's what I think he would do.
Yeah, absolutely.
Everyone would be, I'm going to do that because I'm going to get that.
You hit
It's
the
going to
nail on
help.
the head, Phil. Is it? Yeah. There's a method to the madness. You know, it's not just, hey, I'll work 6 days a week for essentially the sake of just paying the bills, and I don't really know where the money goes. There's a reason. There's a rationale, and there's an end goal. And that end goal, you know, the more that the time's put in the front end, the longer the enjoyment at the back end. Yeah. And that's kind of the intention here, is that it's got a shelf life. It's not going to be forever, ideally. And yeah, look, he doesn't love it, but he knows that it's for a
and he's
reason.
been doing it a while as well, right? Yeah. He's been on the tour since he was 18.
But
right?
A great example, and I know the inner workings of his portfolio prior to working with us, but still, like you said, patient is very key. Started early, got the goals, and held long term, held property for 30 years now.
See, that's another P, right? He's hugely patient.
Massively.
You know, and he probably hasn't deviated from the strategy, right? You know, he's strategically patient.
Yeah.
I talk about that as an asset that people have. He doesn't duck and dive. He doesn't, like, when it doesn't all work out, he doesn't go, I'm changing everything, I'm moving. He goes, it's just continuity. So he is the true property mogul.
Absolutely. Yeah, I agree. And more of those, because they're the people who are going to be self-funded retirees by just doing real simple things really well.
There you go. Well, that's not what I wanted to talk about today, because we've had a whole bunch of questions coming through, and we've been sandbagging and waiting for a time to do it. And we thought, you know, as we're getting up towards the end of the year and people to start sort of, you know, thinking about what's going to happen in 2025 and all the noise that surrounds that at the moment, which I've been given some commentary on around interest rates and all that sort of stuff. I don't know what your view is. We'll touch on that really quickly. I'll ask you that. It's going to be my question.
Yep.
But I've got 4 or 5 other questions here, which have come through the social media. People just going, what about this? What about that? So we thought we'd pick the best ones out, and thank you everyone for writing in. And people do enjoy these type of things, and we'll just give off the cuff. I've just seen these questions.
Yep.
You know, they're printed out for me. I've skimmed them. I haven't even yet formed a view of them. So we'll do that completely off the cuff. But my question, Paul.
Okay.
When are interest rates going to come down?
Mate, look, we just had interest rate info and news come overnight, both here in Australia and over in the US. It sort of seems like it's still trending the same way, where a couple of months in a row you'll see it's declining, and all of a sudden you get this sticking point.
Inflation.
Inflation. And obviously that's going to dictate a few things. I think I'm of the view that March 2025 is probably circa when I think it will happen.
Really?
Yeah. I mean, look, there's a few things overnight that information probably deters most people.
Inflation going to come down on interest rates?
I think interest rates. When's
the first meeting?
We've got a meeting in December.
Yeah.
But the first one's in Feb, then March, I believe.
Then May.
Yeah, I know this new schedule's sort of thrown me out a bit, but I think it'll be at the end of the first quarter, maybe sometime early second quarter 2025.
Yeah.
Yep. That's when I believe it'll start. Now, will it be sort of what the US and Europe have done, and New Zealand and some other countries where they go bang, bang, bang? I think they'll probably be a bit more cautious, because we're not in as higher interest rate period as what many of the other countries are overseas. So I think they're going to be probably slower, more methodical, and wait, test, measure. And I think that's what's going to start it. Now, there's obviously a lot of bills going through Parliament at the moment as well, like as far as the
Build to Rent and Help Me Buy went through yesterday.
It got through. Yeah. I mean, it's not fully through, but I mean, it's got through the upper house, or the House of Reps rather, yesterday. I believe it was yesterday. And then we've got APRA discussion about the buffers being talked about.
I think that's been canned. I think I saw someone come through.
Okay, gotcha.
Buffers remain, I believe.
Yeah, which, I mean, look, that's not going to dictate too much. I mean, that if anything, that probably helps the cause for interest rates to come down, because if that got released, and you're into a position where
Sorry, to Help Me Buy go through the Senate or went through the House of Reps? It's got to go to the Senate.
Go through the Senate. Okay. So it's went through House of Reps, I believe, yesterday.
Because I was down in Canberra on Tuesday of this week, and with a whole bunch of pollies in that, and man, they were busy, And
36 bills going through today, apparently.
And I was sitting there going, and I was speaking to someone in the opposition, senior member of the opposition, and I went, "What?" And he had the rush off. He goes, "Phil, I got to go back to the office. It's madness, right?"
Yep.
And I went, "What's going on?" And he went, they're just trying to clean the house.
Yeah.
They're just clean the house running up to the end of the year, try and push some
Leading
stuff
up to
through.
election, trying to get all these things.
And a lot of people are just going, oh, whatever. Like if it's good, they yeah, sure.
Yeah.
No worries, sure, no worries. There'll be stuff that they can tend on. But yeah, I saw that come through.
Yeah. So, I mean, anyway, I guess for me, there's a few things that are going to influence one way or the other. But I think before mid next year, definitely, I think either Q1, Q2, I think for me personally is when that first cut will probably be pushed through.
And talking about interest rates is a national sport now, but it's probably more than property. Like
it has become.
but rather than being what people at a dinner party start talking about property straight away. Normally the conversation starts with interest rates, and everyone will complain about it, right?
Yeah, absolutely.
And I get a little bit fatigued with the conversation because everyone's got a view on it. No one knows.
No,
right?
No
one knows. I've got an opinion.
From the man or the woman, Michelle Bullock, all the way down to the punter.
To Phil Tarrant.
To Phil Tarrant, everyone in between. No one actually knows.
It's a national sport.
Literally.
It's an absolute national sport, which I find intriguing.
Yeah.
I reckon if we get an interest rate cut next year, I think and that's an if, it's going to be later in the year.
Yeah, okay.
I reckon there's a chance we won't see anything next year.
I don't
and
disagree
I think
with
people
Phil.
should be building their finances and their decision making around interest rates are going to remain. And I've said it before and I'll say it again, just because the RBA cuts a rate doesn't mean your lender will pass on.
Yeah.
And that's going to be the big discussion.
And if I look at anecdotally the people I speak to, as far as property investors, people with a mortgage, people with a principal place of residence mortgage as well, are they running on a knife's edge as far as the family budgets are concerned? I don't see that in my conversations as well as the numbers I look at. Now, obviously, I look at a cohort of people who are action takers and are typically in a position where they're talking about
action takers and decision makers.
That's
who
pretty much
did
it.
we steal that from?
Is it Panos?
No.
Typically, no.
Aaron Christie David.
Oh, there you go.
Because this podcast, the Pure Property Podcast, has been popping up on my social media feed, and that's the thing. You know, it must be he's got a property. What's he say? Property. And Aaron Christie David. Go and tune in the podcast. The last one we did.
Yeah, it was a good one.
A mortgage broker, and the greatest benefits of property investors are action takers and decision makers.
Yeah, absolutely. And it is exactly that. That's typically are the people who win. And I've lost my train of thought.
Really?
Yeah.
No. We're talking about
Easily
interest rates and people sitting on the knife edge.
Yeah. Well, sorry.
Budgets.
It was more that
You work with action takers.
But like you said, Phil, I think if we don't get a cut, and if we do only get one cut next year, if it happens early, if it happens later in the year, I don't think people are sweating it out, thinking our family budget is kaput if we don't get this pressure valve released. I mean, and not just the people I speak to, but the data still suggests that we still have relatively strong surpluses. The arrears data, the 90 days arrears data from a banking perspective is not running out of
where it's at.
Yeah, it's still pretty consistent. So I look at it holistically to say, are we in a massive drama if we don't get a cut in 2025? Yeah. Is the property market in general going to spiral out of control? No. Is it going to stabilise? Yeah, absolutely. It'll moderate it. Certain markets will still grow, and there's certain markets that are still growing exponentially. But what it will invariably do, some of those markets that have been depressed, i.e. I can think of a couple like Victoria or Melbourne specifically that have been depressed for a good 5 years. If we don't get an interest rate cut, will that mean that it's going to go backwards? Well, I don't necessarily think it'll go further backwards, but I think it'll push that more pent-up demand for a point in time when it does start to release, and you'll probably see those markets will actually go quicker and probably go higher in a shorter period of time, whenever that might be.
Yeah. What I would say to that, and it's going to sound a little bit like a disclaimer, but I think it shows the consciousness that we have here on the Pure Property Podcast, and also empathy, I would like to think. We're having this conversation assuming that the people who are tuning into this podcast are property investors and are down a pathway of property investment. I don't think the cohort of Australia who would tell us that we're out of touch and don't get it probably aren't tuning into this, right? So I just want to make a point that there is cohorts of Australia who are probably struggling on the family budget.
Absolutely.
The people you work with
Absolutely.
are action takers and decision makers. So that's just one grouping of people. There is other people who are probably redlining it and struggling and really doing it tough out there.
And small businesses as well.
And small businesses. So there's certainly a level of consciousness. So we're not saying all of Australia is like that. I'm saying that there is pockets. We're probably talking to the minority, to be fair, of people who actually got their family budget in order and driving forward.
Irrespective of the economic environment.
Put it in perspective, right?
Yeah.
You know, so I just want to acknowledge those people who are doing it tough. You know,
Sure.
there is there is a housing crisis in many ways. There is people still living in their cars, and like this is for the government to fix, right?
Yep.
And hopefully they are fixing it. So what we're doing, we're talking about those people who are proactively and actively investing in property. But what's happening in Sydney? I saw some stuff coming through.
They're talking about a -5% 2025.
Yeah, this is another one of my questions. Sorry, but like there's a huge oversupply allegedly of apartments in certain pockets of Sydney. Some areas are coming off like a huge amount of percentage points. Off the plan apartments, I think in Epping Way or North Ryde or that sort of area, like a huge oversupply.
Yeah.
Yeah, so here we are, we're talking about huge oversupply of property and prices rapidly coming down and people can't sell their stuff.
I have a theory, Phil.
Here we go.
And this is going to rub some people up the wrong way.
That's all right. That's what we do.
Disclaimer, send the hate mail to me, not to Phil, because this is my theory, not yours. I call it the Triggerboff effect.
Okay.
Since about 2010, 2005, 2010, in that era onwards, I've not very, very extreme detail, but to a level looked at number of supply in the apartment market, specific to Sydney I'm referring to. Now, Sydney apartment market in general over the last 20 years hasn't been terrible. No. It's been the best performing apartment market in Australia if you generalise what's happened from a capital growth standpoint. But when you look at specifically developed Meriton apartment blocks, which are typically extremely large sites, what you end up invariably seeing is that there is a change to zoning within those general areas. And what that does is it throws out the supply level for a period of time. And I can think of markets from East Lakes to Strathfield to Zetland to North Ryde to Epping to there's a range of other areas across Green Square. There is sites that Meriton in particular, and I'm not throwing out Meriton apartments saying they're terrible products or anything to that nature. Everyone can have their own opinion on that, but it's the supply that it creates in an immediate period of time, or typically within a 2 to 4 year period of time, which then skews data for a period of time thereafter. And this is a general rule for anyone who's looking at what influences property. It's a real simple method when you say supply is the enemy of capital growth. It's as simple as that. And when you see these massive sites come out, you mentioned a handful of different areas which are struggling and going backwards right now. There is a change to where you look at the skyline and there is a large amount of apartments that didn't exist 5 years ago from a height standpoint, which throws out supply. And that has to get absorbed, and it takes time for supply to get absorbed before you hit that new equilibrium. So Sydney in particular areas is going through that. And that has happened for the last 5, 10, 15, 20 years.
Nothing's new about that. And I'll take the point. And you see it coming through now that that infill is going to be how we sustain a growing population. I completely agree with it. We talk about Melbourne, they can keep going out. Sydney, you're a bit sort of constrained, right? So, for large developers like Meriton, in many ways, they're the story of Sydney, right? Because they're investing in this stuff, right? Like they're putting their dollars down to develop these huge swathes of
affordable, most part semi-affordable,
so semi-affordable apartments that will populate Australia and Sydney siders in Australia, and how we're going to do it moving forward. So, someone needs to do that.
Absolutely.
So I think we're fortunate as a nation, and we have people like your Meritons and whatnot who will go and do that, right? Because someone needs to do it.
Absolutely.
If they don't, we're stuffed, right? That said, that doesn't necessarily mean buying one of those apartments is going to be, inverted commas, a good investment.
Correct.
In time, it may be a good investment. However, there's going to be a point in time when, if you buy the first apartment in a new apartment building, there's going to be 20 other towers going up side by side, a huge amount of supply.
Yep.
So maybe that will constrain capital growth, and maybe that will constrain your ability to transact or trade that property.
Yep. Yeah,
you just got to be aware and conscious of that. That's fact. There's nothing wrong with that. That's a reality. We're going to start developing and rezoning huge swathes of Sydney, and that's happening right now. You see it in the papers right now. So that's okay.
Yeah,
you just need to be conscious of it. So if you're buying that home to live in, sweet. Yeah. No worries. If you're buying it on the basis as it's an investment property and you're going to expect capital growth, maybe less so.
Yeah.
You just got to know the purpose of buying it for.
And be comfortable with, the fact of the matter is if you're buying a property that is easily replicatable or in a development that has multiples of that property that can and will come out of the ground or is already out of the ground and will come on the market to sale in the forthcoming months, years ahead, you just got to be realistic with the outcome. Just because you're buying a property off the plan in what's perceived to be marketed as a boutique location and it's got all the amenity, etc., I can almost guarantee that any apartments that are getting approved right now are in good locations for that reason. Because
but all these new ones you only look at here, they're on the new metro.
Exactly. They have to be because that is why that's sensible town planning. But don't think that that's a reason why you can jump into it and no one else is thinking that way and you've struck gold. It's unfortunately probably most of the time going to be the opposite.
Yeah, and it comes back to the stats. Most Australian property investors own between 1 or 2 properties. I think a lot of Australian investors would own stock like that. Yeah. Yeah, I'm generalising, but...
No, because they're easy to get into, 5% deposit, sometimes no money down for a 1, 2 year, 3 year period of time. You don't need to worry about how to get finance initially. People are like, this is a way for me to get the foot in the door. But you don't be blind to the fact that you've got to pay the piper at some stage and you are going to own that property. You're committing to a property. Yeah. That's a 30-year commitment in all reality.
That generally is a 30-year commitment if you're buying that sort of stuff, because if you want to trade that in 3 or 4 years, it's
don't expect to make anything.
No. Yeah. But look, just be aware. And it works for some people, it doesn't work for others. But other areas of Sydney's west and southwest is still... I hear sort of still pushing along with capital growth.
Yeah, and generally speaking, the bottom 25 percentile market is the best performing market. Now, that's not just Sydney. That is in every other major metro market as well. So freestanding established houses, bottom 25 percentile. If you compile it down to that wedge, that is the wedge that's outperforming. And it has outperformed for the last couple of years. And I expect it'll probably outperform for the next 5 years ahead because of where this, not just because interest rates are higher than where they have been over a previous period of time, but asset prices have increased. Yes, incomes are increasing, but we're at this point where even as and when interest rates come down, property is not getting cheaper. It's not going to happen anytime soon that it's going to get cheaper relative to incomes. So you're going to see that people are still getting compressed to this bottom edge of the market. Now, the freestanding houses, 3 or 4 bedroom accommodation, bottom 25% affordability range.
That's still $700,000.
It still is. Sydney's still 7, 8, 900-ish grand. Other markets more like 5 to 700. Yeah. But that's where the majority of people are going. And also, that's where the majority of renters are going. So we can't forget the fact that rents have exploded. Now, they've played a lot of catch-up from a really subdued
even rents are really starting to soften.
They are starting to soften in certain areas, but they had a big boom, right? So, but they typically, even if they plateau, they're still 25, 35, 45% higher than where they were 5 years ago. So you still got people who have to move into these more affordable areas to rent as well. Yeah. So that's the melting pot right now. So if you're an investor, that leaves clues. Start thinking that way. I mean, I had a meeting literally this morning with a wealthy individual, owns a property.
Property mogul?
Not a mogul, no, far from it actually. Owns a home worth close to 10 mil, very little debt on it, has really good income, business got bought out by private equity, has a great situation. But had a property, sold it, but now is trying to get exposure, has a very big ability to borrow, but is going through the motions of figuring out, do I go after multiple assets in the 1-2 million range, or do I go after assets in the 600 to 900 range, knowing that I still have a 10, 15-year horizon I want to buy for. I'm not necessarily concerned about cash flow, but I want to see growth and I want diversification. That's a classic example where, look, you could go and buy 5 properties in the west of Sydney at $2 million today if you wanted to. Yeah. Is that going to be the best use of his utility? Probably not. And we're going through some strategy there at the moment. But that's an example of saying just because you've got the means, don't think that you should otherwise be thinking, I'll just buy more expensive.
And that's when you need to get a different perspective on things.
Absolutely.
Right? Yeah, and that's the smart counsel for whoever told him to go and speak.
To me?
To one of Australia's top 1,000 buyers agents. But it sort of links it in with our first genuine question. That's just mine with the other ones. And it's sort of irrelevant to structure, but it is consistent. What is your ideal first property to put into your SMSF, resi or commercial?
Yeah, and Phil, we both sit on the opposite side of the ledger here because you've bought property
commercial.
in SMSF, you've got commercial, I've got commercial and resi in my SMSF. I look at this.
I'm a shares mogul in my SMSF. Mate, my share portfolio's been doing all right.
Yeah, until it's not. And then you say, well...
I just need one bad day.
then you just need one good day.
I've had better returns on my in growth and yield. Oh, maybe not yield, but in growth in my share portfolio than commercial.
There you go. Well, mate, but is that including leverage?
No leverage.
Yeah, see, and this is one of the key questions.
Zero
Yeah,
leverage.
exactly.
Yeah.
So the leverage is your key. So you leverage that at 3 times.
Yeah.
Would you have been better off buying another commercial?
Probably.
Maybe, yeah.
Yeah.
But again, look, I'm not gonna pour.
Well,
pour
maybe
water
not
on your
percentage
fire,
terms, but at an aggregate, as in cash on cash.
Yeah, that's it,
would
cash on cash.
But the thing is also, and I'll preface that also, is that it's really easy to value your share portfolio at any point in time. You look at it,
Absolutely.
it's
real.
It's real. But, with commercial property in your SMSF, you've got to get it revalued every year,
Yep.
right? And I got a valuation back and I went, oh, that's pretty good.
So,
know?
question, if you don't mind sharing, Phil, walk me through those numbers of top line of your commercial property purchase price and where the value
Yeah,
is.
I'll talk about one of them, which is the one I'm happy to talk about.
Yep.
I think I paid $1 million for it.
Good round number. Easy.
Yeah, it was like 1.05.
Yep.
I would call it $1 million.
Yep.
70% debt on it. It's still positive. It's positively geared. So I bought it before interest rates started going up, and it was putting 40 to 50 grand in my back pocket every year.
What were the rates, and what are the rates?
Ooh,
Because I know rates right now. If you're going to buy commercial, you're paying 8%.
They'd be in the sevens, maybe high 6, maybe low 7s.
Right.
The interest rate on it.
Is that a legacy
P&I,
rate?
yeah.
Yeah.
P&I, I'll have to check it out. It's low 7s.
Yeah, okay.
P&I, it was putting 40 to 50k positive
Probably
every
more
year.
neutral-ish now.
It's positive-ish. It's not negative. It's positive.
Yep.
Well, I'll tell you what. Also, like maybe it's something we can talk about here. But I think the valuation coming at 1.3.
That's a good valuation.
Yeah, it's 300 grand in 2 years in Perth.
Yep.
So I have exposure to the Perth market.
Yep.
But, if you look at SMSF investing in particular, because of the structure you have it in, you've got all the rigmarole of this because commercial is great because you obviously get all your outgoings paid for, everything's net,
Yep.
money around in your bank account, good property. You didn't buy it, another buyer's agent bought it, and people would know who that is, who you know quite well. We're fortunate in Australia, we've got a really good cohort of quality buyer's agents, which is really good. One of the downsides of this is I've got to be registered for GST on it because it sits inside of an SMSF, a trust vehicle, and the income that comes in is over the threshold, so everything is GST. That's a hassle.
That is
so
a
I've got
hassle.
so it's another entity.
So do you
I
have
need
to
do
lodge
BAS.
quarterly BAS?
I've got to do quarterly BAS.
Oh,
so
no,
it's a
I didn't even think of that. That's a punish.
So I have quarterly BAS and quarterly pay-as-you-go income tax withholding, because obviously the fund is positive.
Yep.
So I've got to do quarterly BAS and quarterly pay-as-you-go tax on it. So it's like it's another business, and a lot of people go, SMSFs, blah blah blah. You get to a threshold, because there's no GST on residential rents,
correct,
but there's GST on commercial rents. So
which is not only a time barrier; it's also a cost.
Yeah,
it's a fixed cost.
It's fixed cost. So it costs me.
What does that roughly cost you if you were to annualise?
Accounting fees?
Yeah, accounting fees.
I don't want to put a number on it because I don't know if my accounting fees are.
But let's assume $1,000 or $2,000 a year.
It'd be a bit more, I reckon. But that's it's a deduction, right?
Yeah, exactly. It's just
but because you've got positive contributions going to the fund, and you got income coming in, and I typically top up my super to the maximum. It's covered. It's cool.
Yeah.
But that level of compliance, like be careful.
It's permanent.
And if you're not me doing BAS and GST and PGA, I do it all day long, so it's not an issue.
Most people aren't wired like you, though.
But most people, for a lot of people, go, well, what? I've got to pay. I've got to pay. No, I don't want. If you're not in business, if you're a PAYG person, you're going to go, this is all confusing. What do I do? How do I do it? This is stressful. Blah blah
Good
blah blah blah.
It's going to help you through that, but it also is a fixed cost, and you still have to do some work with it. There's documentation. It's permanent.
Yeah.
So that's a perfect segue, because the question is, first SMSF property, or even if, let's say, it's a second or third,
resi or
I go
commercial?
resi or commercial?
Yeah.
Now, you raised some really good points there that I was going to raise, which gives me, or gives our listeners, probably a really good point of reference here on the ledger. So let's start with some facts. If you're buying commercial, you mentioned you're 70% LVR on this. Picture you're going to be putting 30% deposit down pretty much as a minimum, plus another 5% for closing costs. So let's work off $1 million asset, 300 grand cash, and then another circa 50 grand for stamp duty, closing costs, etc. So
and a buyer's agent's fee.
Yeah, and a buyer's agent fee if you use one on top of that. if I look at that versus resi, and let's work off $1 million in resi just as $1 million purchase in resi, you can actually, technically, there is actually a couple of lenders now who do up to a 90% LVR in that.
In
plus
SMSF?
In SMSF for residential. So straight up residential SMSF.
Really?
Yep. I can mention Granite. I know
Granite
factually as
Home
of
Loans,
today, they do it. There's a few others.
What sort of rate? Competitive?
You're paying a little bit higher, but 0.2, 0.3% above what your 80 or 70% LVRs in SMSF are.
So 7 point
Mid
something?
sevens,
Yeah.
mid sevens to high sevens for a 90% LVR,
Yeah.
low sevens to late sixes for a 70-ish
In
percent LVR.
SMSF?
Absolutely.
That's really come down.
Absolutely, yeah. So
Because they were up at 8 and 9 like quite a few years ago.
And,
and
and 90% didn't exist until about 10, 12, 18 months ago. I haven't got the specifics in front of me. But that in itself, so you think $1 million asset, that's $100,000 plus another 50 plus say another 25 for closing costs. So $175,000 for $1 million asset versus $350,000 for a commercial asset. That's double the capital that you would need to tip in. So either A, you can get double the amount of value of the asset, or you can start with a slightly lower or a significantly lower amount of funds, so you don't have to wait until your fund gets to a certain level. So that's a very key point. So entry...
But to that point, though, and I'm sure we'll talk about this, so we'll talk about it now, if you're borrowing 90% of the value of the property resi, you're going to be negative.
Yeah, absolutely.
You're
And
going to be negatively geared.
this is where you know, and I'm not suggesting that a lower deposit is a pro or a con. I'm just giving those facts. So,
And in many ways, in the worst case of that scenario, is it's so negative that your contributions, your super contributions, don't cover the gap.
Well, there's also risk there, So you've got to make sure you know what the contributions are going to be, and also how long you have left in the workforce. You know, because you've got obviously a bigger debt relative to the price of the property, so you want to make sure you've got a bigger, essentially runway to get that paid off. So let's assume that you've got double the capital needed for resi, for commercial versus resi. If I look at the growth, and this is probably not taking a short-term view, this is taking a long-term view. If I take the holistic data of 30 years worth of commercial versus resi, it hovers, and this is from offices to warehouse to everything bulky goods, lump that all up, it works around somewhere between 4 and 5% average annual compounded growth if I look at it on a national standpoint. Resi works out to be 5.5 to 6.5 if I look at units, freestanding houses, blue chip versus entry-level markets, etc. Now, generalising there, so don't shoot the messenger to say your example is above that. I can look at plenty of examples which have gone backwards, and there's a range of other things in between. Assume that, and assume, let's say, 10 years of compounding growth. If you're buying $1 million asset, that's going to get, say, 4.5% average annual compounded growth. $1 million over 10 years works out to be circa about $380,000, $400,000 worth of growth over 10 years. Residential, if I was to apply, say, circa 6% average annual compounded, works out to be about $750,000, $780,000 at 10-year growth over that time. So there's about call it a $300,000 difference potentially, $250,000 to $300,000 difference in growth. Now, that is a subjective number because obviously it depends on what you select. But if I'm going to generalize all the data, potentially $250,000 to $300,000 difference. Now, that's growth. However, then you lump in cash flow. Now, your example is a good one where you say, okay, well, let's assume you get a 6% net return from a commercial asset, and let's assume you get a circa 4% net return. That would be generous. Let's say 4% net return from resi. Now, say net, typically 5.5% gross will work out to be at 3.5 to 4% net. Now, this assumes that net return also factors in the higher interest rates that you'll incur for commercial versus resi, because you will incur 0.5 to 1% higher for commercial on average. So that's why your net will be slightly less as well. I'm going a little bit technical here, but if I go again, that same $1 million asset, 10 years ahead, what's that work out to be? Call it about $20,000 a year cash flow difference, better for commercial versus resi if you say, look, average all that out. So 10 years at $20,000 is $200,000 difference. So you've essentially potentially got $250,000 to $300,000 better return from a growth standpoint in resi, but you've negated $200,000 in cash flow versus commercial. Maybe you've negated that $250,000, $300,000, but you're better net. So yeah, people
so
are probably
commercial
hearing
wins.
it. Well,
Because the way I would argue that point,
and you'd sit on that ledger because you have, and you'll be biased to it. And I don't have a bias, if I'm honest with you, Phil. But I talk about my biggest, and this
I'm not saying a bias. The point I wanted to make was you're going to end up
at the same
about the same, right?
destination.
But the money that's positive inside of your SMSF with the commercial property inside of it,
Yep.
you can use that money, the positive money.
Yep.
So your contributions that you're putting into your fund isn't going to pay off your loan. Your contributions is going as cash and it's investable.
Yep.
So you can use that positivity to save up more money to invest in another property and or invest in shares or some other asset class. So if you have that resi property in your portfolio, your contributions are offsetting negative cash flow.
Correct.
If you have the commercial property in your portfolio, your contributions isn't offsetting negative cash flow. It's contributing to positive cash flow, which is going to give you more money to keep going.
Yep.
So I would say commercial wins on that basis, even though like for like those two properties, 10 years, probably going to be about the same.
I'll throw one separate aspect to this equation, which is the thing I was discussing at the start, is that because of the larger deposit needed, you've got to also factor in, do you sit on the sidelines
You could
longer?
start sooner.
And I just did some math and so that we talked about 175 grand was the difference on those same two scenarios.
Yeah.
If you're contributing, say, 30 grand a year, that's about 5 or 6 years it takes you to get to that point. So if you lost 5 or 6 years of compounding growth, then you start to assess where's the value and the lost. And you know, this is it, right? Like, and I guess it rounds up to saying, I think we did a pretty good job of going through all these numbers, to be fair, but it also shows pretty clearly that there is no cut and dried answer to say, here's the way you should go.
No.
Because there is a lot of variables. And for me, getting some expert opinion on this and advice on this, not just on what asset to buy, but structuring your loans correctly, making sure that you've actually got all the accounting side set up correctly. There's a range of different things you need to consider. And hopefully that gives everyone an idea.
That sort of lends itself to giving a nice disclaimer there, because everyone is different.
Massively.
So that we're just talking about this in general. So there's no advice whatsoever on that. But it goes to show how deep you need to go in terms of making that decision. So that's a really good question. Ideal first property in your SMSF, property versus commercial. Here's another question. This is everyone's thinking about this.
Right.
How cheap does Victoria have to get to compensate for all the extra levies to hold the property?
It's a good question.
It's a great question, and you know, look at the Victorian market, particularly Melbourne market right now, man, it's pretty subdued, right? There's a
10-15% in the last 5 years it's done.
I saw some map of all the places which are negative and in crisis, like you know, apartment market in particular.
Apartment market, a bit scary. Yeah. Particularly the sort of north of 6-8 story apartment market, which it's not a isolated
I think
scenario.
I was sort of talking about this early in the year around the Docklands area.
The Docklands, the South Bank sort of equivalents.
It's the biggest white elephant in the world.
It's been that way forever, though, right?
Yeah.
Like, I mean, we've been talking about this, Phil, for 10 years on this show, right? Like, just talking about that market, and we've had multiple people who've invested in that market in different forms just talk about the fact that they bought that and they wish they didn't, and the reasons why. But it's not. It is what we talked about earlier. Supply is the enemy of capital growth, and that is the problem with those areas.
Yeah, and I think you're going to be waiting for quite some time to actually get that sorted out.
Properties.
So how long? How cheap does it need to get? So cheap's a
it's a subjective
relative term. Yeah.
I kind of look at this to say I personally have an opinion that I think the Victorian government over the last 3, 4, 5 years has done an absolutely terrible job at actually explaining what they've done, and more particularly since early last year when they changed their land tax thresholds, actually explaining what does this mean from a dollar value perspective. So to lay out some facts here, and don't fact check me in the sense that I'm gospel, go and do your own research on this, but from what I know, as of early last year, 2023, the Victorian government, they had a pretty big COVID bill that was a hangover from some decisions made during the COVID times. Now, they had about a $4 or $5 billion revenue position that they were trying to raise over the forthcoming 10 years, and they thought land tax on property, or people who own more than one property, whether they're Victorians or someone else from Australia or elsewhere, we're going to sting them because that's where we're going to get this $4 or $5 billion back over a 10 years. So this is a first point. This is what they deem to be a temporary tax. It's a 10-year tax. So good luck repealing that and changing it. I dare say that'll be forever.
Sounds like payroll tax.
It does a bit. But look, let's say it started 2023, so that's got another 8.5 years to play out technically. So when it came down to what they did, they changed their land tax threshold from what was $350,000 land value, anything cheaper than that, there was zero land tax applied, to lowering that threshold to 50 grand if you were an individual investor, or if you're a trustee, 25 grand is the threshold. So basically saying that you more or less pay land tax from day one. Yeah. Now, that's fine, but what does this actually mean? So we've gone to the point now.
They backdated it as well.
They backdated it from when they introduced it to when it actually got gazetted, and I think. But it wasn't like if you held a property for 20 years, you get this huge tax.
No,
bill.
I remember I got a couple of years of stuff.
Yeah,
and I was like,
but that was a full Tarrant tax as opposed to a land tax, no doubt. It probably wasn't enough, in my opinion. But that being said, the dollar value is really what people need to consider here, because, and this is what the Victorian government do a terrible job of, is trying to explain how little it actually is. And in my opinion, it's small, because, I mean, I pay land tax in a few different states personally, and it is what it is. I got my land tax bill for Queensland only a few days ago.
Yep.
And it is what it is, right? That this is the price.
Do you pay your land? It's just a question. Do you pay land tax in big lump sums, or do you go into payment plans and pay it off over the course of a year? Depends.
Depends on when I get the bill and my feeling at that point in time.
but it's a
they
really
always
good...
give amazing incentives to pay it off up front, don't they? It's
like,
we
get
give you about
$50
$6 off.
But it's a really good point. Speak to your accountant about this, because maybe a lot of people don't. When you end up with large land tax bills, you don't need to pay it all up front.
You're giving the ATO money immediately, unnecessarily.
And you look at the it's going to cost you a little bit more.
Yeah.
To amortise it over the year, but if for cash flow management, it's actually not a bad strategy.
Yeah, and where that money would otherwise be sitting. But
it's horrible.
We do digress.
Yeah.
But it is part of this. So for anyone who's thinking about buying in Victoria now, and with this new land tax that's applied to it, and goes back to the question is how cheap does it need to get? The market has done next to nothing. If you factor in inflation, it's gone backwards over the last 5 years. So historically, it is actually, in my opinion, very affordable and very cheap right now, comparative to where it's been historically over the last 25 years. Now, that being said, you are paying a little bit more for the privilege of holding property there. So if you bought a property, let's say a freestanding house worth 500 grand, land value of 280 grand today. And when you go down the pathway, you pay that. What you're incurring now is that the changes are any land sub $300,000 in land value assessed by the Governors General there, you are paying a flat land tax of $975. Above that, above 300 grand, it starts to be the flat 975, and then it's apportioned of a percentage thereafter up to certain amounts. But to put it in perspective, if you had a $500,000 land value, assessable land value on a property or properties in Victoria as of now, it works out to be $1,100-1,200 a year. So when you then assess that, so let's say compare that to Brisbane or to Perth, and you had those as options you might want to invest as opposed to Victoria or Melbourne right now. There's a few other fixed costs which don't go away, which then you've got to, don't just look at land tax in isolation. So let's say you don't pay land tax in Brisbane as an example for a $400,000 land value, which you won't if it's in your personal name and you just got one property, and Perth, relatively similar, right?
And there's still thresholds in trusts as well.
Exactly, there's still thresholds. They all vary, so check the relevant authorities and websites to do so. But then you say, okay, well, what's property management in Victoria? Roughly speaking, it's about 6.5% to 7.5%. What's it in Brisbane? Roughly speaking, about 7.5% to 9%. WA, roughly speaking, 8.5% to 12%. So you start to think there's about a difference of $1,000 to $2,000 a year in fixed costs that you pay more in Queensland or more in WA or more in Adelaide or even Sydney, not so much, because it is affordable and it's probably a bit less actually than Melbourne. So that in itself, then you factor in council rates, insurance, all the other things that go with it, water rates, etc. The fixed holding costs in Victoria or Melbourne right now actually aren't any more expensive on par than any other state, in my opinion, when you compare like for like. So how cheap does it have to get? In my opinion, I don't think the land tax or the holding costs are going to be a long-term deterrent. I think there's a really bad PR work from the government that haven't actually explained what it means very well, and is it actually going to be a huge deterrent? Yeah, they're going to raise some revenue, but most other states are already raising that revenue in other forms anyway. So all that's done is that the Greens and the Coalition have done a really good job of figuring out how the hell do they essentially taint it and make sure that this is just seen to be really bad policy.
Yeah.
Which it's bad management prior to that, and I'm not going to go into all that components, but in my opinion, it's not a massive issue to say, how can I hold a property in Victoria long term? You've held property in Victoria long term, Phil, and you no doubt will continue to do so.
Yeah. Oh, look, I'm not going to make investment decisions around Victoria based on whether or not I need to pay land tax. It just goes into
You wouldn't buy property if that was the case.
It just goes in your sums, right?
Yeah,
and
exactly.
the cost of doing business. And again, this is one of those things you can't control.
Yep.
Just so factor it into your budgets. If it makes sense, it's still cool. What I would, I don't know if you've seen this yet, and it's sort of connected to what you're saying. Pauline Hanson from One Nation Party. She does. Have you seen her videos?
No, I've seen a couple of. I think they've been doctored on the socials.
No. So she puts out these videos all the time. By the way, which the politicians find hilarious,
Really?
right? Yeah, I was chatting with Peter Dutton once. He goes, "Have you seen the latest videos? It's crazy, right?" And they find it quite entertaining. Anyway, the most recent one is about Victoria. It's completely connected with this,
Right?
And it's Albo and Dan Andrews in a car, right? And what they do, they're just like, Albo being an idiot and Dan Andrews being Dan Andrews. They crash into Bluey, the dog, and right. But anyway, the whole thing is about how Dan Andrews wrecked Victoria. And their policies towards property continues to wrecking Victoria, and the fact that Albo hates Dan Andrews because of yes, we're both Labor, but all the union stuff, and then I think Bluey comes back and hunts them down. So, mate,
this is Pauline Hanson's doing.
Yeah. She does these.
I didn't think she had that in her.
No, she does these. They're really good. You got to watch them. They're brilliant. It's just like political satire, right? In many ways, but in a Pauline Hanson way. So, go and track it down. It talks about this stuff exactly about Victoria property and just how stuffed it is. It's very politicised, right? And it's obviously making a point.
But that's the point that I'm making there, right? Because I don't think they've had a way to explain this or get people on board with what they've done, which gets anyone on board, as opposed to everyone just hating the Victorian state government and just thinking
got to get beyond it.
Inept.
Grow up, everyone. Just land tax. So what? It's land tax everywhere largely. And,
absolutely.
And if you get to a point where you stop investing in your own personal name, you're going to have to pay land tax. Just the way it works. I hate it. But get on with it.
I think those numbers that I put there probably gives people a bit more just general understanding to say, look, the numbers aren't insane. We're not talking, hey, it's $5,000 a year fixed that's going to send everyone broke. These are relatively modest numbers in the grand scheme of owning a property or even multiple properties. So do it in your math and think about that before you think the market has to get ridiculously cheap before it's affordable. I think it's affordable now.
Are you buying in Victoria?
Yes.
There you go.
But I'm also buying elsewhere.
There you go. Where aren't you buying? It's always
Hobart,
not
Darwin,
buying Hobart, Darwin,
Canberra.
not buying Canberra.
Not in Adelaide anymore.
No, Adelaide's gone. Yeah,
there's a hot tip.
Wow. So everywhere else. Everywhere else. Okay, last question because I'm conscious of time. You might know about this, and it's a good question, but it's a bit technical. What are the details around the postcode restrictions for 95% LVR with no LMI? So you can buy now 95% without LMI.
Yes.
I imagine
up to certain value amounts.
In certain locations. How many certain locations would are you going to tell me where these locations are?
Oh, look, I can give you some general numbers.
So this
because it's postcodes, right?
Yeah. So this is on the basis that the banks just think that's fine. That's going to go up in value. Don't worry about it.
I think it's on the basis of a number of things, is that they look at it to say that the average household income in these postcodes is high, the stability in employment is high, the LVRs in general are low, the net value or the net worth of the individuals is also high. So they look at it and say the risk ultimately is much lower. Okay. So and I'll probably preface this by saying you need to speak to a good investment broker to give you specifics on all of that. But if I generalise, and let's say Sydney as an example, if you look at good wedge of the eastern suburbs, a good wedge of the eastern suburbs of Sydney, you're looking
at 95
up to an $8 million property value
at 95%.
At 95% with no lender's mortgage insurance.
Who's buying $8 million at 95% with no LMI?
This is probably the point, Phil, where you sort of say, okay, well, who's going to go buy an $8 million property with, let's call it what is it, $1.5 million to put down and borrow the rest? Not many people, even if they can afford that. Yep. But where the value is, in my opinion, in this policy, because there is postcodes in Melbourne, there's postcodes in Brisbane, there's postcodes in Adelaide, there's postcodes in Perth. They're the 5 states that I believe may be very, very limited in Adelaide, but they're the 5 states that this applies to, and there is specific postcodes and specific values that this policy applies to, and it's big 4 banks. This isn't random tier 2, tier 3 lenders who have got a whole bunch of nuances. These are your majors. Now, you might not know about this, but you need to speak to a good investment broker who does know about this. But where I see the value of this isn't if you've got a limited deposit but want to go buy a $5 million, $6 million, $8 million home. It's if you live in these suburbs now and you're listening to this and you're thinking, I want to get moving, but essentially, I don't want to necessarily wait till I've saved up a certain amount of cash. I've got a good income. I've got good equity in my home, and I live in one of these markets which may be affected by this policy. You can technically, and let's use an example. Let's use a postcode which I know applies. Let's say 2230, Southern Sydney 2230. You can have a home up to $5 million in value in 2230. And you can get 95% LVR with no LMI. So if you've got a debt on a $5 million asset there right now, let's say you've got a debt of, let's say, $4 million. Let's say a hefty debt on a home worth $5 million. Technically, an 80% LVR, right?
You're talking about a refinance.
Exactly.
Equity.
So I'm saying,
Okay.
well, you might think you're tapped out, but all of a sudden you say, okay, well, you can actually go back to a Big Four bank and say, I actually want to take out $500,000 on this property, and I don't want to use that $500,000 to go and buy 1, 2, 3 investment properties. That's where this policy for me is hugely valuable.
So you're talking about this as a equity extracting play.
I'm talking about as a tool to perpetuate wealth. I'm not talking about this as a tool to say go in with a limited deposit and then go buy a very expensive property. I'm talking about this as you need to start thinking this is probably the best policy, personally I'm speaking, of principal place of residence owners that I've ever seen as an enabler. It's obviously very, very restricted to a certain few, but if you are one of those certain few who thinks you live in an affluent area in any of the major states right now and you want to know more about this policy, that's where I'd be getting busy on it.
Okay, I get it now. So that would be P&I in your principal place of residence where you can go up to 95% to extract equity.
Exactly.
Okay. Yeah, you probably want some good advice from them. Yeah, it's a really good way to frame it as in an easy way to extract equity if you want to start accelerating
Massively.
your stuff. Speaking to a good investment, you can speak to my mortgage broker if you want. They'd be pretty good with this. Finny Mortgages, finny.com.au. Go and chat to Eva, tell her I sent you.
And they'll have the postcodes. So they'll literally,
I'm sure they would know
have all the policy.
But
I guess where the value is that if you set up a time to them and say, look, I've heard about this policy. I want to know if my property applies to it and which bank would it be. They'll be able to literally run it up the flagpole within a couple of minutes and figure out, is that going to work? Yeah. If so, what's available? And then you get that information. Essentially be equipped with the right info.
It's a good idea. Go and check to Finny about that. And why you've got them there. Ask him this question because I heard about this the other day. I don't think it's public knowledge, or very public knowledge. Back in the good old days, and I was chatting with someone on a podcast, and they told me that there is a lender who is providing this right now, and I was really scratched. It really pricked my attention. I went and found out who the lender was, and I'm going to share it with you. Back in the good old days, when you used to come off interest only home loans,
5-year interest
5 years interest only home loans, you just call up the bank and say, can you extend it for another 5 years? Thank you very much. Brilliant for investors.
Yep.
Over the last 5, 6 years, nothing. No, it's just maybe a one-page thing that you just tick a box and
like
sign
a waiver,
it.
essentially.
Yeah. That's what it was. It was just a form. Yep. The last sort of 5 plus, probably 7+ years now, you've got to do a completely new finance application. So it's like you've got to do all the work, essentially, that you would need to refinance in order to go to stay on a 5-year interest-only thing. And typically what has happened is that people use that as a inflection point to refinance to a different bank. Yep. That's what normally happens, because to do a whole new application with your current lender, you shop it around and see what else there is there. So there's a lender who now will just, like the good old days, they've got like an interest-only hotline or interest-only someone or other. You just call them up and you go, I want to extend my interest only for another 5 years. And they go, well, and I'm paraphrasing here. Might be a little bit more to it than this, but pretty much going, do you know by doing that, when it moves to P&I, interest rate repayment is going to be higher because it's 30-year law and all this sort of stuff. And because you factor in the discounts when it goes P&I at that point in time, so it just stays remain. And then I think it's just a form. So
gives people more confidence if you're starting out at interest only and thinking what happens at the end of the 5 years.
What happens at the 5 years. And no doubt the bank is doing this because they just want to retain the customer.
Absolutely.
Because the banks make more money the longer they hold the loan.
Absolutely.
And the bank who's doing this, and I was like, really? Commonwealth Bank.
Oh, there you go.
So if the CBA is doing it,
everyone else
will start doing it. So we might get back to the halcyon days of not having to do full
Wouldn't that be nice?
applications. Would you do it? You're like an interest only.
I have done it.
Yeah.
I do it.
But you've got to refinance the whole time.
I do. I mean, to be fair, my broker does a really good job at doing that for me. But it is still documentation that I have to sign. Even though they do it, I still have to go through the headaches of it all.
Yeah.
Absolutely, I would. I mean, if you're comfortable and confident in the asset selection and you're comfortable with the fact that you're not in the game to necessarily expedite the pay down, then you're in it to hold. You're in it to see appreciation. As long as you can manage your cash flows, even if the cash flow becomes somewhat neutral, for me, that's a comfortable position in my personal ethos of property investing.
Yeah. Well, this is it. So this is what I've heard. Whether or not it's fact or fiction, I don't know. I need to find out a little bit more.
Talk to Finney. I'm sure they'd probably.
I'm going to
facts.
ask them. Yeah, I'm going to go and speak to Finney Mortgages. They know everything. The oracles of finance, the oracles of investment finance.
I like it.
They sometimes don't like me over there because
I reckon probably more than sometimes.
More than sometimes, but anyway.
But that was good. I think we covered some really, really interesting things there.
Yeah, no, we covered a lot. What is being a property mogul? It's not about how big your portfolio is, it's mindset. There you go. That's the key takeaway, plus some other really good points there. Resi versus commercial and SMSF, investing in Victoria, and then these. Yeah, so this is a real tactical thing around these postcode restrictions, don't LMI about. I was thinking, who's going to want to go and buy a $10 million house? It's about refinancing what you already got.
I'm pretty sure your postcode's in there, Phil.
It would be.
Absolutely. Mate, just hot tip. I think you've bought a property recently, which think about that.
Yeah, that's good. Well, where I bought a property recently, and let's call it the North, is it North Shore?
Lower North Shore.
35% is an apartment, 35% in a year, they reckon. Core logic.
Grown.
Yeah.
Right. So it's not reducing. It's not a.
No.
There you go.
No. So I reckon 35%. I don't believe it.
Of course you don't. And this is it. You look at this data in isolation. You're like, mate, that's just. It's just
I don't believe it.
Well, it's not accurate. I mean, you look at the value of your property. It's pretty easy to figure out individually. It's not accurate.
No. So anyway, a lot of people get caught up with it and get their calculator. And
I want you to share the story of your 95% LVR, no LMI equity extraction in the next 6 months, Phil, and then talk to people about how you've done it, what you've done with it, and how it's exploded your portfolio for phase 2.
Is that my homework, is it?
That is your homework.
I don't know, maybe. I don't know if I'll take on more debt.
Please. I've heard it all.
Love debt. I don't know. I need interest rates to come down.
Yeah, well,
struggling.
Nice one. I'll wait till interest rates come down.
I'm just going to wait till interest rates come down. Then I'm going to do it.
Nice one.
So I know we're nearing Christmas, and everyone wants to do everything before Christmas.
Absolutely.
Is your books full?
December's a good month for us. We try to do a lot of our strategies in December in preparation for January onwards. So purepropertyinvestment.com, click on the schedule now button and you can lock in a time in my calendar. If it's not going to be for December, it'll be for January, but also 1300 985428. If you can't get anything on the actual on the schedule now tab that fits your timings, give them a call and say, hey, look, Paul said that you might be able to squeeze me in. If we could find a time, please, whether it's now, whether it's December, whether it's January, whether it's February, find a time that works for you because this is the time to get going. And last thing I'd suggest, and Phil, I can see, do you have a...
No.
You do. Give me a second up here. Those.
Is that the OG or is that the new one?
That's
the next wave.
It is the new one. So stocking stuffers, we're taking bookings for the next 2 weeks. A Surface Guide to Property Investing, the next wave. This is ready to go as a stocking stuffer. Go on that same website, purepropertyinvestment.com, and there is a order now button for the book. You pay shipping. I ship this out to you for free, 30 free.
Really?
Yeah. Yeah, done deal. Probably for the next couple of weeks. So get onto this red hot. We're probably going to stop shipping about a week before Christmas. So if you want to get this in a stocking or potentially...
So what the world needs is another property investment book.
Well, it's the second.
Yeah, that's right. It's the next wave.
Yeah, it's the next wave. Anyway, get that.
That's good. I've read it. I've read bits of it.
Nice one. Bitser.
It's good. It's one of those things, though, to be fair, that book. And I read a lot of books. You can pick it up and spend 10 minutes and put it back down.
Yeah, and it's chapter orientated.
Yeah.
So if you want to
get yourself a beer, sit on the porch,
Yep.
read half a chapter, get an idea, put it down, pick
get
it
a
up.
highlighter.
Yep.
Fold a few pages over.
Nice one. All right, purepropertyinvestment.com is where you track these guys down on the social medias as well, no doubt.
Absolutely.
Thanks for coming into the studio. We'll see you one more time before Christmas, and thanks everyone for tuning in. We'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.